Welcome to FinScribble. Have you ever looked at your mortgage statement, credit card bill, or savings account and wondered who pulled the magic lever behind those changing numbers? Every 6 weeks, world financial markets pause, holding their breath while billions of dollars hang in the balance. But behind the dramatic headlines lies a surprisingly intimate setting. 12 individuals sitting inside a quiet boardroom in Washington, D.C. How do these 12 people arrive at a single decision that directly impacts your ability to buy a home, land a promotion, or grow your hard-earned savings? Today, Maya is taking us straight inside the Federal Reserve's decision machine to demystify the Federal Open Market Committee. When news anchors mention the Federal Reserve, people often assume it is one unified government agency. But the voting committee, known as the FOMC, is structured very deliberately. Inside the boardroom, 19 economic leaders sit around the table, but only 12 hold voting power on interest rate decisions. 7 of those votes belong to the Board of Governors in Washington, who are nominated by the President and confirmed by the Senate. The remaining 5 votes come from a rotating pool of 12 regional Federal Reserve Bank presidents scattered across America. Here is the fascinating twist. The president of the New York Fed gets a permanent vote at every meeting because New York executes all central market operations. Meanwhile, 4 other regional bank presidents rotate their voting rights every single year. Maya points out that this unique structure prevents central politicians from dominating monetary policy, ensuring diverse regional voices guide every final decision. To understand how the FOMC decides, Maya shows us the Federal Reserve's ultimate assignment from Congress, the dual mandate. Think of this task like operating a massive dual thermostat machine connected directly to the economy. On one side, the Fed must maintain price stability by keeping inflation near a 2% target. On the other side, they must promote maximum sustainable employment. The tricky part? These 2 core goals constantly push against each other like a continuous tug of war. If the economy overheats and inflation surges, the Fed raises interest rates to cool down consumer spending. But turning up that interest rate thermostat increases borrowing costs for businesses, which can slow down hiring and cause unemployment to rise. Conversely, cutting rates stimulates job growth, but risks unleashing runaway prices. Maya demonstrates how every single FOMC vote is a delicate balancing act, attempting to keep both thermostats finely tuned without stalling economic growth. So, how do those 12 decision makers decide when to adjust the dual thermostat? They do not rely on gut feelings. They consume mountains of complex economic data. While mainstream media focuses heavily on headline numbers like the Consumer Price Index, Maya shows us the Fed's preferred inflation gauge is actually personal consumption expenditures, which tracks how consumer buying habits adjust as prices shift. Beyond inflation, committee members scrutinize monthly employment statistics, wage growth figures, and worker participation rates. They also monitor financial market signals, like the Treasury yield curve, watching closely for inverted curves where short-term rates surpass long-term yields. Finally, because modern economies are deeply interconnected, the FOMC analyzes international monetary spillovers, tracking central bank policy actions across Europe and Asia. Every single metric acts as an essential dashboard sensor before consensus is reached. When decision day arrives during the formal 2-day meeting, how does true consensus form among 19 opinionated economists? Maya reveals one of Wall Street's favorite diagnostic tools, the famous dot plot. 4 times a year, every meeting participant anonymously submits their personal projection of where benchmark interest rates should sit over coming years. Each warm gold dot on the chart represents one individual member's economic forecast. While the dot plot is not an official binding commitment, it provides global investors a visual map of the committee's trajectory. Inside the room, vigorous debate culminates in a formal vote establishing the federal funds target range, which sets overnight interbank lending rates. At precisely 2 p.m. Eastern, the policy statement drops, followed by the Fed chair taking the podium for a tense press conference, where every sentence moves massive amounts of global capital and financial markets. You might wonder why elected politicians cannot simply order the Federal Reserve to cut interest rates before an election. Maya shows us the concept of Fed independence. Congress intentionally designed the Federal Reserve to operate insulated from short-term political pressures, allowing policymakers to make tough economic decisions that benefit long-term financial health, rather than winning votes. Once the target range is decided, it creates a powerful domino effect. Commercial banks adjust their prime rate, which directly alters borrowing costs across mortgages, auto loans, credit cards, and business expansion funds. Understanding this process transforms you from a passive listener hearing market headlines into an informed decision maker who understands how macroeconomics impacts your personal wallet. When you know how those 12... As always, appreciate you hanging out today. See you in the next one.